economy where they're investing are going to be returning a return in their judgment, the trustees' judgment, a return, and part of that, of course, is what industries are going to be around in Australia and overseas, in which the funds are invested. What industries are going to be around in 10, 20, 30 years? That's not easy to do, I might say. It does require, but nevertheless, trustees have to apply themselves in Australia in that respect, and are doing it in a whole range of areas across ESG, in some cases quite aggressively.
And can trustees easily transfer their responsibility to consultants and say, you know, I'm just a plumber or a doctor, that consultant told me that oil was great for the next 25 years, so are they ethically or legally allowed to say it's not my fault, I made a wrong call? Or?
Yeah, look, today the trustee has the fiduciary duty. They have to make the decision. Yeah. So yes, you can employ all the consultants in the world, and there's lots of consultants in Australia, including me. Not on this issue, I might say. You can employ all the consultants you like, but ultimately trustees have the fiduciary duty in Australian law, and that's been reinforced by our Royal Commission, not just in respect to ESG decisions and investment decisions, but in a whole range of other responsibilities. Yes, look, the growth of consultants in this area, I get somewhat ambivalent about consultants and their role, but at the end of the day, you do need to make objective long-term decisions, and therefore you do need to seek information to do that. But ultimately, the trustees carry the fiduciary and legal duty.
Right. And David, I'm saying this as a Frenchman, and I'm saying this as an Anglophile, so it's not a critique of England because I'm an Anglophile. But in the old days, our impression across the channel was that, the pension regulator and the FSA and the Bank of England and MPs across the aisle, they had a fairly laissez-faire attitude towards trusteeship. They didn't change, or they didn't mind if some pension trustees were, sleeping giant, or were not fully flexing their fiduciary muscles, like they had maybe potentially in English law or UK law the implicit potential power to do things, but maybe many trustees weren't as active as they are today. And I want to thank you and Janice for what the AMNT has done for the past 5 years, because it's really amazing what you have done in Britain by really putting together that think tank and association of trustees, because of course the more you are, the more you can flex your muscles. So it's really great to have AMNT present in the city. But I want to say that as trustees flex their muscles more and more, the impression I have is that all of a sudden the pension regulator and MPs and the Bank of England said, oh yeah, it's great, and they have kind of joined the bandwagon, right? Joined the bandwagon, and now ironically they've moved, in my opinion, from one extreme to the other, and it's almost as if after having been laissez-faire for many years, all of a sudden in the past 12 months they're asking more and more things from trustees, as if trustees could save the whole economy. So they're putting more things on your shoulders, right?
Yes, I think in the UK the old order had two key features. One was the regulators, who tended to be a bit hands-off, and the second feature, which was quite pronounced, was that some boards of trustees of pension schemes took a very narrow view that we are there, so long as we pay the pensions, why should we be concerned with whether the companies we're investing in kill people or not? That's not our responsibility. And both of those, I think, have seen a change. The regulator, as you say, has begun to take a more aggressive attitude, and the most significant development that we'll see on that one will come on the 1st of October this year, when some new regulations for how trustees exercise their responsibilities for ESG, and in particular climate change, and how that affects their business take place. So there's been a big change there. In terms of pressurizing the individual pension schemes, I think, as I mentioned in my introductory remarks, there's been a general move that individual pension scheme trustees have have a role to play. That's particularly pronounced in young members. There have been various books highlighting the interest which millennials have in ESG, and I want my money to be good in social terms as well as being doing good in financial. So there's been an upswell from the ground, as it were, and there's also been, as I say, the development from the regulators. Specific issues, two specific issues have crystallised the issues in recent times. One is you talked of responsibility of directors. Directors have been put on the spot for the balance that they strike between dividend payments to shareholders and reduction in deficits of pension scheme funds, and the general guidance there now has been accepted in a way which wasn't before, is that those two should move together in parallel, that shareholders should not be advantaged to the detriment of the pension scheme. The second one, I suppose, you say, is that there's been from pension schemes quite a bit of pressure on CEO and fat cat pay, and ensuring that the directors have the same pension arrangements that the generality of the workers do, and don't go off on a much more advantageous. So yes, I think coming up from the ground and coming down from the top, there is this pincer movement to improve matters, and we'll see that continue.
Thank you, David. And I think one of the issues that David mentioned earlier, which I think is really critical because it's really a cross-cutting issue, is indices. Indices, which is linked in part to the fact that the fees taken from the asset management community are being pressured, and so basically it's almost the perfect storm, because precisely at the moment when these fees are coming under pressure, some pension funds are saying, oh my god, interest rates are very low. If you have 60 or 70% of your portfolio in fixed income, if you're Danish or French, Jean-Pierre can testify, if you're a French pension fund or Italian and you have 60% of your assets in government bonds, and today they're yielding negatively, it's really horrible. And then you look perhaps more closely at the remainder of your portfolio, and you say, oh my god, I'm losing money on the bond part, what am I earning on the equity part? And then you realize that you are paying fees for active fund managers. Some of them are performing genuinely, but many of them are not delivering the performance they promise, and that triggers a vicious circle where they say, okay, then I'm going to switch out of active fund management and go to passive or beta or smart beta. And so we've witnessed, since the great financial crisis started 10 years ago, an acceleration of the rise of passive management, and so more and more pension funds are switching towards basically passive, and they're also switching towards non-listed assets in the hope that infrastructure, private equity, venture capital will generate those long-term returns that bonds, for example, have ceased to generate. And I think Australia, in many ways, was ahead of the curve, and we look up to the Canadians and to the Australians because they were really ahead of the curve. They started that phenomenon, that trend, a long time ago, and now the whole world seems to be moving towards that Australian model. And I'm glad we have Nick here today to ask him a few questions about, how superannuation funds in Sydney, Canberra, Tasmania have switched a lot to non-listed, and has it delivered upon the promise of additional returns? But first, a question to Julia. So I guess you've witnessed a rise in demand, right, for passive vehicles and semi-passive vehicles, smart beta. So give us a flavor of what pension trustees and pension CIOs tell you about those who are disappointed, I would say, with traditional stock picking. What do you hear from them about that switch to passive?
Thank you very much, Nick. It's been increasingly observed among, in particular, large asset owners more generally, not just pension funds, an increasing move towards passive.
Including ESG passive.
Exactly, that was my second point on how actually large asset owners are very actively integrating ESG in passive portfolios or smart beta factor strategies, and not just sort of pursuing so in the passive or factor indexed spectrum part of the equity investing, one can pursue MSCI, FTSE avenues, which many asset owners are actively doing, but even more encouraging to see that many large asset owners are actually building their own bespoke indices, so alluding to the point Nick made, that has been growing, and more and more asset owners are coming to realization of a need of a bespoke benchmarks and also bespoke integration of ESG in their portfolios. And perhaps also worth mentioning and connecting the points of what Michael and Nick made earlier, I would like to bring a bit an angle on technology as well as touching upon indexed or quantitative investing. We can see with large providers, be it MSCI, Sustainalytics, FTSE, that over the last, I guess, 8 years, there has been a huge growth in assets which are managed with ESG overlays or ESG integration. And in my view, there is also a significant can be played by data growth, alternative data as well, and machine learning and AI. We just had actually started a warm-up discussion with Michael yesterday over our pensions dinner on sort of the role of NLP and other range of machine learning algorithms can play in helping providers, but also larger asset owners with integration of more metrics beyond just sort of providers, beyond scores provided by MSCI, FTSE, and of going sort of beyond what we have at the moment.
Right. And perhaps to Nick, Australia was famous until recently, and I think there was a famous song by Midnight Oil, right? A famous Australian band about our beds are burning, because Australian capitalism back in the Milton Friedman era, I guess, was famous for burning the forest and the beds, and it was a beacon of quote unquote mining oriented, old fashioned, drilling oriented capitalist model in the song, in that old, for those of you who are old enough to remember the lyrics of the Midnight Oil song about our beds are burning. But it seems to have changed, and to a large extent, in my impression, because superannuation funds spearheaded the change, and ministers like the Right Honourable Heath Cherry was also doing a lot of that when he was a policymaker, and so more, in my impression, more Australian investors, including superannuation funds, are switching not only to infrastructure but to green infrastructure, right?
Yeah. Look, it's a very interesting trend, and I've made the point the Australian system is very large. Trustees have the fundamental duty, and it's defined contribution. So at the end of the day, the decisions trustees make are fundamental to the future of the member. Unlike a DB system where, at least in most cases, you would hope the employer is underwriting. So in fact, it doesn't matter how bad the trustees are in a DB system. The employer should, at the end of the day, meet the price. But in a DC system, what I'd make is that the majority of members default. They don't make active decisions. So there's even greater responsibility on the trustees to make correct fiduciary decisions. But again, Australia's relatively unique in that it's one of the few advanced economies where the investments are predominantly in equities, alternatives, infrastructure. They are not in bonds and cash. And that, in my view, is the correct decision, because the long-term returns, at least in Australia, I would argue elsewhere, but there's clear evidence about Australia. The long-term returns in that group of assets is higher than if the monies had been invested in bonds and cash, and therefore trustees have made the right decision. But the evolution, trustees therefore have to take into account a whole range of factors, and increasingly we talk about environmental issues, obviously global warming, carbon trading, moving into direct ownership of infrastructure. So most of the infrastructure in Australia, privatised, brownfield, greenfield, is owned by the pension funds. So airports, ports, tollways, electricity authorities, they're all owned by the pension fund.
And some are owned directly, some are owned
Yes,
across mandates that they give to asset management companies.
yes.
And one of the largest asset management company or infrastructure focused
Yeah.
AM company is actually kind of a cooperative owned by superannuation.
Yes, some of the mutuals have established their own cooperative called IFM. Then the other large infrastructure leader, Australia globally, aside from IFM, is Macquarie. The other reason for moving into those type of assets is they have equity-like returns, particularly if they've been government monopolies, and that is particularly suited to post-retirement phase, where you want equity-type returns. You don't want your members in bonds and cash in retirement, particularly if you're going to live 20 to 25 years. Again, there's fierce argument about that globally, but I would argue the Australian evidence shows that. I'll just finish on one point. The really interesting case is coal. And Australian trustees are not disinvesting from coal. And this might sound a touch self-interest, but
Is
it's,
it what President Trump called clean coal?
well, Australia is the largest coal exporter in the world by a very long way.
Right.
It exports 40% of the world's coal. I think the next country is Indonesia, but a long way behind. So what do trustees do on coal? It's a very significant challenge in Australia. And the argument is, and it might sound a touch disingenuous, mining coal per se is not polluting. The use of coal by other countries, particularly depending on their power systems and their power, the way they use that coal, can be polluting.
It's a bit like cocaine production in Colombia.
Yeah, you can
In
make that
itself-
same argument for
in itself it's no
tobacco
sin, right?
and smoking the stuff.
Well, look, the reality is, at the moment, the return on coal from coal exporting, you can justify in an economic sense.
Right.
And the reality is, if trustees in Australia were to say, well, we're not going to invest in coal, we're going to dump it tomorrow, you would very clearly harm the economic return of the members of the fund. Very clearly you would.
And further
Because the
argument-
coal industry is so dominant in Australia. It's not an easy debate, but all I can say is it's a challenging practical issue. We're also the largest miner and exporter of uranium in the world. Now, where do you draw the line with uranium? Is nuclear power on or off the list? You can argue about nuclear weapons, but should nuclear power be off the list? All I can say, and I detect a bit of agitation and
Michael wants to comment.
and I have raised the issue quite deliberately because these are not easy issues. But before I hand the mic over to get some further comment on coal, the ESG requirement is much more broader than issues around that type of controversy. Executive salaries in the finance sector, women on boards. I mean, there are a whole set of issues here beyond just environmental about the structure and decision making of capitalist entities in a capitalist society. Over to you on coal.
Thank you. No, it's really more a question than a comment because I'm
Yeah.
curious. You talked about fiduciary duty and its exact legal definition, and I was curious whether in Australian law fiduciary duty is actually specifically defined as maximising return for the members, or something looser in the sense of working in the best interest of your member.
Yeah.
Because there you can make an argument about call that switches one way or
Yes, you
another.
can.
Yeah.
And pragmatically, Australian trustees have made that call. The fiduciary duty, which comes from the UK, interestingly, the old common law is to act in the best interest of the members, to invest the money in a diversified way as if it were your own, in a diversified way as if it were your own. There's very little case law, although the Royal Commission has touched on this. I compare, but the overlay in Australia is because it's a compulsory, mandatory defined contribution. Everyone in society is in the system. Therefore, trustees would argue that you have to take the attitudes of and views of people in society into account when investing the monies in a compulsory DC system. That's quite a fundamental difference from a lot of other pension systems. And to conclude on this note, I was a trustee 35 years ago when the Australian system was set up, and there was no debate about these issues in the community. Therefore, there was no debate amongst trustees. I mean, there was just no discussion. Today, the world is very different. Community attitudes are very different. And interestingly, trustees have led this discussion in Australia. The regulators tended to follow, to the extent the regulator now says trustees must include these considerations in its decision making. And I think that's been, and I think it's the centrality and the relative unique features of Australia in that retirement context and the trustees' duties that have led to the rise of a lot more active involvement, reporting, change, pressure by the fund trustees. And at the end of the day, they're big enough to make a difference.
David?
Yes, could I start by endorsing what Nick said about default funds? UK, increasing life expectancy 30 years. It is not viable to have a default fund which consists of putting the money in government bonds with such low return. So hence the need for looking at wider interest. Not easy issues. I'd flag up two that have cropped up in the UK in recent times. One is the view of some ministers that you've got a big bag of money for your to pay your pensions, and I've got a social need that needs to be met. So can I have your big bag of money to meet my social needs? And whether the financial disciplines have been put in place to make that a viable proposition need to be looked at. Some ministers have suggested that it should be a target for spending on infrastructure. At the moment, the current climate of opinion, I think, is that the state trying to predict winners in the economy is not really a very good idea. So that's the first one, I think, to flag up. The second one, on the case of coal, our notice court case on this one was the National Union of, now quite an old court case, called the National Union of Mine Workers. The then Secretary General of the day was keen that the National Union of, or the Coal Pension Fund shouldn't be used to buy oil shares, which he felt were fueling the competition. Personally, I had some degree of sympathy with that, in the ground that if you are in the business of extracting coal, encouraging people to use oil isn't necessarily a very good idea. But the outcome of that court case was that he overstated the case, and the law has remained unclarified. Now, you probably, Nick, know how long ago that was, but it's a sort of decades rather. Yeah. So I think yes, the issues need to be addressed, but there are some real issues which need to be come about before the conclusions are reached.
And I think, just quickly, Nick, I mean, it's not perfect. I mean, the dilemma Australian trustees are faced with in a practical way. But at the end of the day, I think that trustees' fiduciary duty has been a positive force for good and will continue to be, at least in the Australian context. And I think has been positive in leading to a lot of change. Maybe not as much change as a lot of people would like, but it has been for the positive good in a whole set of areas.
Right. Now, I'm going to use that issue because I think it touches upon a critical point. Most of us agree that it has been a force for good. There's no doubt about it. And I think that trend towards countries where trusteeship doesn't exist, because sadly trusteeship started as an Anglo-Norman legal concept. So we, the French, invented it, but we lost it. So basically we don't have in modern French law, we don't have that beautiful Anglo-Norman concept of trust law, which is very powerful, extremely powerful. And I think you guys in Switzerland, you have something called fiduciaire, but I think the Swiss fiduciaire is French or French-Swiss, is much narrower. It's a much narrower, more very particular kind of corporation. It doesn't have the broad meaning, the broad corporate governance meaning that trusteeship has in modern English. And in France, in France we don't have it. And I think it's interesting because it was the concept of trusteeship to a large extent was born in the days when English and Scottish and Irish aristocrats all spoke French, and when they went to the Holy Land during the Crusades, they would need to leave the keys of their castles, their domains, and their wives' chastity belts to the trustees. And so the trustee was the person in charge of managing the estate and the rest, while the knight was in Acre or Antioch freeing up the Holy Land. And so that notion is very important, because you are really giving something very precious to the trustee. And fast forward today, these employees, these workers, these nurses, these doctors, these lorry drivers in England, when they have a pension fund, generous or meager, it doesn't matter, when they're de facto giving that power to the trustee, they are giving him a huge responsibility. And so a lot of things, once again, fall upon his shoulders, and the government may be tempted to add new responsibilities upon the shoulders of these trustees. So basically, by default, also that's contributing to empowering the trustee, right? But the question I want to ask you all, especially Nick and David, is, many lay trustees, and I think it's important to have lay trustees. So many of them are civil engineers, architects, physicians, nurses, spending time, allocating precious time that they could be spending with their families or golfing across here at Lenny Vale Golf Course. They're allocating a lot of time and resources to serving a higher purpose, which is really great, and we need them to do so, of course. But the question I have, does the government or do corporations allocate enough resources to the training, education, travel expenses of trustees to attend conferences? And if the government, if the companies don't do it spontaneously, could enlightened MPs maybe pass new laws or regulations telling, CEOs of companies, large and small, X% of whatever the HR money devoted to continuing education or CPD must go in priority to trustees. So do you favor such kind of legal or regulatory evolution in Britain or Australia?
Yes, role of lay. First of all, the scale of the problem. There are about sort of 7,000 active pension schemes in the UK. So if you say that each pension scheme ought to have a board of about 7, that's quite a lot of trustees that you need to produce. Next question, can you produce enough trustees who have the confidence to do that? The analysis of the pensions regulator is that there's a shortage of decent trustees. So the question then is, how do you use the trustees that you've got and spread them around and consolidate the funds as necessary in order to reduce the cover that's required. And that debate is very active at the moment. There are severe moves to curtail the number of schemes that are involved, to cut out what the pensions regulator calls the long tail of schemes where governance is not what we would wish it to be. That's a severe issue. The second question is then what sort of trustees should you have? Should they be have some sort of formal qualification? Lay trustees, as you say, tend not to have a background in the main pension disciplines, and
sometimes better.
Our view is that, going back to my remarks at the start, a well-run pension scheme has three sides of a triangle. Side one is the employer, side two is the experts and the consultants, but side three is the members. And those three sides need to be kept in balance, and the consultants and experts shouldn't have a monopoly. And the sort of business failures that have affected dramatically some pension schemes have been better tracked by the lay trustee with broader commercial responsibility than the specialist. So I think that's important. Having said that, I mean, the whole reason that the Association of Member-Nominated Trustees exists is to provide training and background and guidance to trustees. And yes, we're very much in favour of trustees knowing what they're up to, but knowing what they're up to doesn't necessarily mean specialists in particular types of investment. You know, it's a broad awareness.
Right now in Britain, for example, for your average, let's say FTSE 100 or FTSE 200 corporation, roughly on average, a trustee can easily take 5, 6, 7 days off to be trained, or is it only 2 days? How does it work?
Our membership is about a quarter of them are trustees. I'm a trustee of the pension scheme, and I still work for the company, so that's easy. Yes, give them time off, and